Ever wondered, what if the housing market crashes right after I buy my home? That's a valid fear, especially considering the tumultuous housing landscape we've seen from 2023 to 2024. Picture this: you've just bought your first home for $400,000. Your monthly mortgage payment is around $2,800, which is nearly half of your net income. It's a stretch, but you're hopeful. However, as the months roll on, houses in your neighborhood aren't selling as fast, and prices are starting to drop. Think of a neighbor's house similar to yours, listed for $420,000, but eventually sold for $380,000. This sale sets a new, lower benchmark for property values in your area. As this pattern continues, your home's value could drop to somewhere between $300,000 and $350,000. Suddenly, you owe more on your mortgage than your home is worth. This scenario may sound familiar. It echoes the housing market crash of 2007 to 2008. But unlike those who bought before the crash, you might be better protected. Perhaps you secured a mortgage with a low interest rate and affordable payments. However, if you're a recent buyer who stretched your budget, the risks are higher. You might not be able to refinance due to a lack of equity. And if your income drops or you lose your job, you could face some tough decisions. Fortunately, banks and lenders have learned from past crises and now offer programs to prevent foreclosure, like loan modifications. These measures can help homeowners keep their homes even as property values decline. Fast forward 2 years. The market has bottomed out, and your home is now worth significantly less than what you paid. At this point, the housing market could stabilize or begin to recover. The key to weathering these potential scenarios is financial prudence, buying a home you can afford, even in less than ideal circumstances. In summary, the possibility of a housing market crash poses real risks, especially to those who stretch their financial limits. The lessons from past market downturns emphasize the importance of purchasing a home within one's means and avoiding speculative thinking about real estate as a guaranteed investment. Instead, view a home primarily as a place to live rather than a financial windfall. This approach can provide a more stable and realistic perspective on homeownership in uncertain times.